Let's get straight into it and take a look at CFC Stanbics results that are out. What do you make of its performance?
Well, looking at the results, the main thing that underscores the results is the impairment charge on investments in securities. But if you look at the loan book, if you look at the interest income, it was basically within expectations. It's only that now you look at the different earning structure and the new revenue structure that we see from all these business units, insurance and the financial business units together.
Well, the impairment charges are at about 699 million shillings, and it's affecting the earnings per share of the bank. What exactly do you think the bank should do about its impairment charges?
Well, basically, you will see that the impairment charges this year were twice as much as what was previously impaired in the previous year. And most of these will probably relate to the insurance businesses, because the insurance business units and the bank operate within have different underlying methods and investment strategies. So mainly, I think the proposal to demerge these business units will be quite productive in separating these business units together and creating more earnings visibility on the results.
Well, some of the analysts are saying that there are concerns about the South African approach to the Kenya's business environment within banks, and it's making it difficult for new entrants in terms of readjusting to the environment. For example, EcoBank posted 1 billion loss over the period. What do you think of it? Do you think that the South African business environment is susceptible to Kenya's economy right now?
Well, the banking sector in Kenya has been quite competitive, and the point has been banks have been going out to get niche markets. If you operate within the niche markets, then in the markets which you understand best and where you can think you can deliver the best growth opportunities, that's what most banks are looking into right now. And with reference to South African banks, coming to Kenya, I think CFC Stanbic has in the past shown stable performance. It's a mid-tier bank, and we think this bank has also opportunities to reap in the banking from their niche markets.
Let's talk about the loan book that was taken over by the new merged entity from CFC Bank. How much was the company in debt before they went into the merger?
Well, I'm not very sure about the figures exactly, but when the merger occurred, when the business units were put together, it brought together the different capital structures, the different balance sheets of the different business units, and from CFC and from Stanbic Holdings.
In terms of cost management, where exactly do you think the bank should be cutting down on costs?
Well, right now, you saw the expansion, the impact it had on the earnings. The cost base went up, increased headcount, increased staff cost by 27%. So mainly the main thing here is to limit the costs, how much expansions they can continue doing, and within the same cost base. So the main thing is to turn the branches profitable while maintaining costs.
Well, prospects for the bank for this year, are you positive on it?
Well, this is positive for the whole banking sector as a whole. Discounting the impact of the impairment in investment securities, I think this year is going to be a better year for banks as a whole, and even for CFC Stanbic. Interest income is projected to grow this year as banks turn more to lending into private sector rather than lending to the government.